social video gaming.
You have to be like utensils
No, I have. I literally just got in the market for one yesterday.
Cool. And we should share some of these thoughts on classification.
Yep. I'll probably do next week's like that. So we have virtual but we're definitely looking for one. The trick is, I mean, you know, for myself, the monthly fee, it's not a problem for me. All the other instruments, you know, I can't figure
Yeah, there's definitely some trades.
How are you doing?
Hey man, good to see you. Really sorry about that somewhat awkward conversation.
Oh, sorry. I should have queued off the non-like, what's up? Like usually you get the what's up face.
Yeah. Okay, so thanks for coming.
Goodbye.
Yeah, we're good. Thanks for coming. The way this works is it's really easy. I would like a 30, 40 pages worth the question is, that's cool, man. That's a really all you gotta do is connect. We'll get started here right now. Welcome to SAP. Sorry, I didn't know that. Yeah, you just kind of sitting there while
It's kind of weird. Yeah.
Yeah.
Yeah,
All right. Just get started. All right, so there's a couple of people still rolling in. I'm going to play a quick 2-minute little intro video about Capital Factory just while more people are coming in, and then we will get started.
Austin is really becoming a well-respected tech hub, and Capital Factory is at the center of that.
We came in with this idea of like, we're going to start a company together because we start companies together.
There's so much going on here, and there's just the right mix of people here.
There's the right investors, the right employees, like there's the right peers.
The Capital Factory has events that run pretty much every day.
You know, our guys after the meeting are like, hey, by the way, if anybody's looking to hire, you know, come talk to us. No, actually, come over to our office. It's another 40 feet here.
The entire growth of your startup to probably your first 20 employees is contained within the Capital Factory.
So whatever you're recruiting for, whatever tech stack or platform or hardware or software, or even 3D printing now, there's almost always those people coming to your office on a day-to-day basis. And you just sit around at nighttime, they'll probably give you free pizza and beer.
And you want to demo your product after the event. Well, you're here at Capital Factory.
One of the coolest meetups that I've been to at Capital Factory is the Women at Austin meetup, is I was able to network with other women entrepreneurs.
Working with other people who are in the same spot as you were there 6 months ago, or going to be there 6 months from now, and it was really cool.
The entire atmosphere is wonderful. The meeting rooms that you can reserve. Here's a really good office environment that we take care of everything. Oh, by the way, there's free snacks. Oh, by the way, there's this managed conference room situation.
But one of the best resources here at Capital Factory is the office hours.
The Capital Factory Mentor Network is now so big, and the number of people in almost every industry vertical that are there now, and most of those guys are entrepreneurs themselves.
And you meet mentors, you meet other entrepreneurs, like for us in particular, I met my co-founder here.
I met my co-founder up here.
There's just a real critical mass down here.
Our developers went to one of the development meetups and we met our newest developer, Kyle, there, and we hired him.
The Capital Factory was with us for 2 years of going from that sort of ambition to the actual reality of having a successful company with like, significant amount of money raised and like a high functioning team.
Technology is just as much about community as anything else.
You become part of this national family of people.
Awesome. All right, I think we got everybody here. This is the How to Meet Investors. I'm Josh Baer, and we've got our guest investor with us, Chris Shonk, in the back, who's going to be joining us for the Q&A for the second half. So thanks for coming, Chris. I'll introduce him a little bit more in a minute. We're going to go through about, like I said, about a presentation for the first part and then Q&A. Most of you probably found out about this on social media. And so really appreciate you helping to spread the word. We love putting these on, and fortunately the room's pretty full every week, but part of that's because people find out about it. So if you see anything interesting in this whole time, if you find one interesting thing worth sharing, we'd love for you to share that on social media and either tweet about it or post it to Facebook or put it somewhere so other people can find out about it. I'm at Joshua Baer. This whole series is at ATX Startup Scene, and the website for all these meetups is atxstartupscene.com. So this one's How to Meet Investors. You can find this presentation online. The startupscene.com link is all the meetups. The presentation itself, or at least a fairly recent version of it, is slideshare.net/Joshua Baer. And then the YouTube channel, all the events that we do here are recorded, so there's a camera on the ceiling right there. This is being streamed on the internet right now, so we're all live, and they all get saved. And so you can go watch old videos. One, there's different videos, different topics up here. But in addition, you think like, why would I go watch an older version of the same talk that we just saw? Well, you'd probably fast forward through my part where I'm talking, but every month when we do this, we've got a different VC or a different investor up here. And so you'd see different questions and you'd hear that person answer those questions. And that can often be pretty interesting and useful as well. So this is a short talk, and fundraising is a big topic, and lots of other people have talked about it. There's all kinds of stuff on this place called the internet, where they have all these smart people who talk about all kinds of things. And so there's there's very little that we could give you here about fundraising in general that you probably couldn't go find something on the internet that probably is better or awesome or different, right? And so here are just some great resources on the internet that I would go check out and read to just learn about fundraising in general. The first one is just like a seminal post by Paul Graham, the founder of Y Combinator, on fundraising in general. The VC economics post there is pretty interesting because what it teaches you is how the VC business model works, which is the people you're going to ask money for, and understanding how they're thinking about it when you're going to ask them for money is pretty helpful. And then there's some other videos here and other things as well. So some good resources there. Again, these links are online too. Also, here are some good books to check out. Get Backed was a best-selling book. It was actually written by two Austinites, Evan Baer from Outbox/Able Lending, and Evan Loomis. And this book is very kind of practical focused on how do I put my pitch deck together and how do I go pitch investors? What do I need to go do? How do I make a list of investors? How many people do I have to go talk to? And it is really, really well done. So I'd highly encourage that. They just came out with a new edition of Venture Deals. Venture Deals is really kind of the definitive book on how venture capital and startups work, written by Brad Feld, who's one of the founders of Techstars, and his partner Jason Mendelson. And so that's a great resource on just how venture capital and investing works in general. And then finally, a great book called Startup CEO. This covers not just investing or raising money, but also all parts of having a board and building a team and growing your company. And it's by one of the best CEOs I've ever worked with, Matt Blumberg, who's the founder of Return Path. So I'm going to, like I said, you could go read on the internet a lot of things about fundraising. What I'm going to focus on is what's different about fundraising in Austin and what's different about fundraising here. As much as I say that, it's kind of ironic because a lot of things that are different about Austin are really the things that are different about Silicon Valley. And pretty much any place that's not Silicon Valley is going to say a lot of these same things are what make them unique or what make them different. And one of those things is that most places that aren't Silicon Valley tend to have a bootstrap first kind of mentality. It's not the only way to do it, but most commonly you're going to see that you're expected to do something first on your own before people are going to go give you money. 10 years ago, you could have a great team with a great idea, put together a pitch deck, and someone would write you a check for $5 million on your pitch deck. on the idea. That doesn't happen so much anymore, unless you're like some badass serial entrepreneur and you've done this like 10 times before, and then they will still do that. But most of the time, you got to show that you can do something first, and that show that you can build a team, show that you can build some kind of a product, show that somebody wants it, and so it tends to be a bootstrap first kind of place. Going hand in hand in that, Austin tends to be very, very revenue focused, meaning they want it, the first question you're going to get asked is like, how do you make money? And they want to know, how's this going to make money? And it's going to be generally easier to raise money, raise investors. It's going to be easier to attract employees, easier to get press, easier to do a lot of other things if you've got a clear way to go make money. Now, one of the things I'm really excited about having Chris here for today is Chris is one of the more rare consumer investors in town who maybe wouldn't be quite so worried about some of these things. So let's see what he has to say about it when he comes up. But a lot of investors you'll find in Austin tend to focus on these types of businesses, and that tends to lean towards more to B2B businesses. It doesn't have to be a B2B business, but most B2B businesses are going to be very clear revenue streams and other things like that. And many consumer businesses start not exactly knowing how they're going to make money. Austin really favors experienced teams. So it's much easier to raise money and grow your business if you've done it before. Probably like a lot of things in life. It's not really fair, it's just the way it is. And so if you've got an experienced team that's raised money before, you're gonna get a higher valuation, you're gonna get more intros, you're gonna find a much easier time. And if you have a very green team, you're just gonna be expected to get more done. You're gonna have to show traction. You're gonna have to show something first, usually before people are gonna bet on you. Now, one of the things that a lot of people don't realize about a startup is that one of the best ways to improve your startup, one of the fastest, easiest ways to bring up your game, to make you much more investable, to make you much more likely to succeed, is just to add somebody awesome to your team. And that's not easy to do, that's hard to do, but I think a lot of people don't realize that that's an option, or that's one of the most impactful things they can do that changes everything. And a lot of times you'll have a company that is having trouble fundraising or maybe isn't that investable, and they add somebody awesome to the team, and then suddenly everything gets a lot easier, and suddenly it is easy to get funding. So how to meet angel investors. This is going to be very tactical, just kind of the obvious things, but first thing is leverage your personal network. And that's because the best intros are always from people that you know. The best intros that I'm going to respond to are from when someone I know sends me an email saying, hey, here's somebody else that I really think is valuable that you should talk to or you should meet to. The best possible intro is from a CEO of a successful company that I've invested in. So one of our most successful companies is pretty well known is sparefoot.com. If Chuck Gordon, the CEO of Sparefoot, sends me an email and says, I just met this awesome entrepreneur, you got to go meet with him, that's going to rise right up to the top of my radar, right? Now, there's lots of other good intros too. Getting an intro from one of the mentors here, or another investor, or your lawyer, or a service provider, or a friend that you can work down the stack. The best one's going to be from another CEO. But another thing about the personal network is, I think a lot of people just don't realize how big their personal network is, and it's usually bigger than you think. A lot of people think their personal network is just their immediate family or immediate coworkers, and your personal network is all those people and then everybody else that you interact with over the course of the day and everybody that they interact with. And you need to really work it. Like, using your personal network is hustling and working it, and I think a lot of people don't take that far. So start there, because none of the things I'm going to say next are going to be as good as somebody making an intro to the right person. That's important. So next thing, go where the investors are. That's part of why you're here today, right? You came to an event where we know there's going to be investors up on stage. You come to Capital Factory and there's investors walking through the halls, or CTAN's doing their screening sessions here, or there's investors doing office hours in there. So this is one great place to go. Lots of coffee shops and bars and events in other places all over town where you know they're going to be. And so go where the investors are. Follow them on Twitter. That's one good way to get to know who some of those people are and to kind of develop a relationship with them. If before you go pitch somebody for investment, they kind of you meet them even online, or maybe you see what kind of things they're talking about and you just respond and engage with them about the things they care about, or the things they're talking about, then they're probably a lot more likely to take your meeting or have a positive impression of you when you go talk about what you care about. And this is a informal Twitter list that I manage of just Austin angel investors. As I come across them, I add them on there, but there's a whole bunch on there you could watch. Creating an AngelList profile is another way to get yourself out there and have people notice you, and there's angel investors that look for that. Do office hours with CTAN. I'll talk more about this, but CTAN's the Central Texas Angel Network. It's one of the largest and most active angel groups in the country, based here in Austin. So it's a great resource, and they do office hours every month where you can go and get a few minutes to sit down with a few different investors and get some feedback. We do office hours here at Capital Factory as well. We do some public event called Epic Office Hours, which in some ways is similar to CTAN's event. It's anybody can come sign up and plug in. We typically theme them around healthcare, veterans, women, minorities, all kinds of different things like that. And then as a member here, you get access to office hours that are happening every day. So right now in the kitchen, there's a few people doing office hours. I was just doing it before I came in here. And every day there's about 10 people, 10 mentors or investors here at Capital Factory on the calendar doing office hours and available to the people that work here. And the way you get access to them is by becoming a member of the community here. And that's a big reason why a lot of people apply for accelerators, is usually they're fundraising. Usually they're trying to meet investors, so they're trying to get themselves kind of shaped up, get their both get the introductions to the investors and get themselves prepared to meet the investors. And then finally, participating in pitch events and competitions and just being out there and being part of the community. I think those are good things to do. I actually think, again, this is actually intentionally somewhat in order. I think the things at the top work the best, and then you kind of work your way down. So step by step, what do you go do if you want to go start fundraising? Well, one, like I said, to start with, go do your homework. Because the worst thing is, there's so much information on the internet. It's easy to not be naive about this. So I'm glad coming here was one step. That's great. To come here, you should feel good about that. But you should go do your homework. Go read stuff on the internet, watch videos, do other things, get educated about it, because it's easy to and you can. So if you go talk to investors and you haven't done the basic stuff that you could have done yourself first, then you're not going to impress them very much, right? So you want to make sure that you know the things you could know on your own. And then you're going to make basically like a one-pager, maybe a two-pager. That tries to succinctly describe what you're doing, the key parts of your company, overview of the team, the product, and your progress. Where are you? What's your traction? What have you actually done? And I think Mark Twain had a quote. He said something like, "I'm sorry this letter's so long. I didn't have time to make it shorter." That's kind of what applies here. It's hard to make something concise and short and easy for people to understand, but it's really important you do, because no investor is going to read your 40-page deck or your 40-page business plan, especially not before they get to know you and get interested. So you have to find a way to do that to get their attention quickly in a 1 to 2 pager. And then you're going to find someone friendly, whether an angel investor or another entrepreneur, and go run it by them and strategize with them. You're going to go back and forth with them on it a bunch of times and try to get it, to where you feel like it's really good. And then you're going to go show it to somebody else, and then you're going to tear it up and start over again and make a bunch more changes to it. But basically iterate with some friendlies who are going to give you feedback to get to the point where you feel like it's pretty good. And then you're going to go start talking to a bunch more people and potentially make a bigger pitch deck. And really just through an iterative process, talk to a lot of different people about it and get feedback and start tuning your path as you go. And then typically somewhere along the line, as you're doing this, there's a saying, when you want money, ask for advice. When you want advice, ask for money. So start off asking for advice, and just start asking for lots of advice and for help. And then at some point, hope that someone triggers and says they want to give you money. Not that they say that it's all hope or anything like that, but that's a lot of times how this happens. You're talking to a lot of people, you're getting lots of feedback, and you really connect with someone and hit it off, and you find your first angel investor. And most commonly that happens on a convertible note, which is just typically the choice is to either do an equity investment, what's called a priced round, where they get stock in exchange for their money, or to do a convertible note, which is technically a loan, but really the important thing about it, the way to think about it, is it's just a much simpler document that you can do much faster and much easier and much cheaper, that will, if the company is successful, will work out the same way in the end. And so that's really the idea, is to make it the reason people usually do a convertible note is just to make things happen faster and easier, and to avoid some of the negotiation and other stuff that you might want to wait till a little bit further along to go do. Again, around that time, you might apply to an accelerator. Typically, companies applying to an accelerator it's not like they come in with just an idea. They typically are coming in with a product, with some traction, with some customers, and they're looking to really take that to the next level to scale it. And then if things go well, in Austin anyways, you're typically going to raise anywhere from $500,000 to $1.5 million on that convertible note. And it'll mostly come from angel investors, not from venture capitalists. Occasionally you might see 1 or 2 venture capitalists put in $250,000 each into a round like that and kind of have a placeholder for it. And that's a good sign. Even better if you get more than one of them to do it. But most of the time when this is happening, the VCs aren't participating in that. This is typically all angel investors that they're raising. And then again, if things go well, and nothing ever goes on a perfect path, but like if things are going well, then your next step is typically to raise what In Austin, we'd call it a Series A. You might call it a seed round in California. You can get caught up on the terminology, but typically on the order of like $3 to $6 million, and that would come from a VC, often from an Austin VC, maybe from one from outside of Austin. And in a situation like that, if you're raising $3 million, it's probably like the VC puts in 2, and the other $1 million comes from more angels or other people like that. And so that's kind of like the basic path, again, that I see. Sorry, jump slides. That I see people going through here in Austin. So a couple other things. Office hours. That was one of the recommendations I made was go to office hours. So what is office hours? Office hours is basically like speed dating with investors. Now you're not necessarily trying to pitch them to invest in your company. That'd be like walking up to a girl at a dance and asking her to marry you. But it's more just a way to meet a lot of people quickly and get a lot of feedback. And so you want to prepare for that. You want to obviously think about how am I going to make the best use of that time. I'm going to get a short amount of time with each person that I meet with. So first of all, I probably shouldn't spend the whole time talking. That probably would not be a good meeting. So what am I going to say in the first minute or two really quickly to get across what it is I'm doing and make sure I give them time to talk. And do I know what I want out of this meeting? Am I just looking for general feedback, or am I looking for something specific? Am I looking for introductions to investors? Am I looking for feedback on my business model? Am I looking for a co-founder? Am I looking for someone I need to hire? Am I looking for my first customer? There might be all these different things that you need or you're looking for, and you want to be able to articulate that and tell them that up front. Hi, I'm here to meet with you. I'm going to tell you about my company, and I'm hoping that you might be able to introduce me to some other angel investors. Or I'm hoping that you might be able to give me some feedback on this so that they can tune in on what you want out of them and what they need to go do. Ideally, do the homework on the person you're going to meet with. You might not always know who that's going to be, but if you can, again, you're going to really impress them and look prepared if you've done some homework on them. And you say, hey, I realize that you've got a background in running massage MDs, and that's a franchise business, and I'm really interested in franchises, so I was hoping you could tell me about this, right? Well, that's going to make them much more engaged and interested and make you look smart and you look good. So that's some tips on how to make the best use out of that. And like I said, don't go into office hours asking people to invest in your company. It's not like you're going to meet somebody at office hours and get an investment. What you want out of office hours is another meeting. You want to make a connection. You want to be like, hey, I really liked talking to that person. I think they like talking to me. I wonder, do you want to go get lunch? Can we go talk about this more? That's what you want to get out of that. Or so obviously some specific feedback or introduction or something like that. That's all the stuff I just said. Okay, a couple other things. We'll get to Q&A as fast as we can. That's always the best part, but this just gives us a little bit of a baseline. This is an interesting chart I found somewhere. I didn't make this up. But what this is supposed to kind of show is to help you think about, should I bootstrap my business or should I raise money? Bootstrapping is when you pull yourself up by the bootstraps. That's the phrase. But the idea is that you start your business on your own. Many entrepreneurs I know, and many of the entrepreneurs here at Capital Factory started their first businesses bootstrapping. I bootstrapped my first business when I was in college. I had a credit card my parents gave me, had the money they gave me for buy food for the semester in school, and that went towards buying a computer and then buying a bunch of other stuff and basically, bootstrapped my business. Part of bootstrapping a business is starting a business when you're really not supposed to be able to. You don't actually have all the resources you need, but you figure out a way to do it anyway. So that's bootstrapping, and then venture capital would be all kinds of raising money from angel investors, VCs, anything like that. So what this chart basically says is there's two first things you want to look at is how scalable is this business, how big can it be, and how much money does it take to get there, how capital intensive is it. So if the business is not very scalable, it can't get that big, and it doesn't take much money, then you should bootstrap it. Because if it's not that scalable, you can't raise money for it. VCs don't want to invest in something that's not going to get really big. And it doesn't take much money, so you can bootstrap it because you don't need much money to get started. So that's a good thing to bootstrap. If it's very scalable and takes a lot of money, then pretty much the only way to do it is to get money from a VC because you need a lot of money, and most people just don't have a lot of money to go put into it. So you have to raise money. So that's the other obvious kind of side of it. If it's not very scalable and takes a lot of money, then it's probably just not a very good business. So that's this bottom box, right? Like if you want to do things that can be very big and don't take a lot of money, that makes a good business. This one gets a little more complicated. So here, if it's very scalable and not very capital intensive, then you ask a third question. And then the question is what are the barriers to entry? If I go do this, how hard is it for somebody else to come compete with me? Or how likely are they to? Maybe I'm in a niche market where I don't think they will. And so if there are strong barriers to entry, like I'm doing this and I don't think someone else is going to compete with me, then maybe I can still bootstrap it because it doesn't take a lot of money and I don't, and so I can go make it work. If there are weak barriers to entry, if it's easy for someone else to come compete with me, then that's going to make you lean more towards raising money because you want to have more kind of you want to have more resources to move more quickly, because then otherwise somebody else might raise a bunch of money and come compete with you because it's easy for them to compete with you. So I found that to be a pretty helpful chart. We can pull it back up later if you guys have more questions about it. So one of the other things everybody wants to know, of course, is like, well, who has all the money? There are lots of angel investors, and I've talked a little bit how you can meet some of those, and Austin has a very robust angel investor community, both within CTAN and then private individual investors outside of CTAN. This is a list of all the VC firms here in Austin. These are just I feel like every time I make this chart, there's a new one I'm missing. About every 6 months, there's a new VC firm launching in Austin. I know 2 or 3 other ones that are working ones now. You hear rumors about things. I don't have any info. I wouldn't be surprised if Chris is raising a new fund right now. True Wealth just announced their fund. Capital Factory's we're always working we have a fund. We're working on the next fund. And I know other people working on new ones too. Now, what you'll see across this is very common in Austin. Most of the VCs considers themselves to be Series A investors investing in tech startups. And so that's the bulk of it. And so they're looking to be the first institutional money, the first professional money after angel investors, and they're generally looking for tech-enabled companies, software companies. And so that's going to be the bulk of the ones here. Some of the things that you'll see there, and probably the most active firms in Austin. So Silverton Partners has been around probably of these, I think the longest, and certainly the most active in Austin. Live Oak Ventures is a little bit newer, but since they've come, also very, very active. The two of them probably the most active here in Austin. S3 Ventures, right up there with them. And the difference with S3 is S3 has access to a larger pool of capital, so they'll also do the next round of funding, Series B funding. So for example, S3 Ventures did the Series B funding in Favor, and you guys use Favor to order delivery food, and also in Outbound Engine, another great company here in town that's doing really well. And so they can come write a $10 million check, $15 million check for the Series B funding. And then also you see a couple other things. I mentioned Chris in the back is probably one of the investors in town more comfortable with consumer products. Not that nobody else will do it, but I know it's something he tends to focus on. So B2C type things, and I think still generally tech, as well as some consumer packaged goods. That's what CPG stands for. And you'll also notice on here Cavu, Clayton Christopher. Clayton was the founder of Sweet Leaf Tea and Deep Eddy Vodka, and he's now got a VC fund focused on investing in those kinds of companies, in consumer packaged goods businesses that he can help grow. And the way I think about a consumer packaged goods business is that's a product where one of the key differentiators on its success is distribution. How does it get onto store shelves and get distributed? And obviously there's a lot of physical production and other components to it that we don't have to deal with software. A couple other things you'll notice, Sante focuses on biotech and health primarily. True Wealth Ventures is primarily focused on female companies that have female leadership and female leaders in them. And AVX, which is basically what's left of the Austin Ventures Fund, it tends to focus on more B2B tech. And then also, here are the accelerators in town. There also tend to be more and more accelerators coming. I put Y Combinator on here as well. They're not here in Austin, but I think if you're here in Austin, that's probably the one not here in Austin you'd be most likely to be paying attention to or apply to. When you think about an accelerator, I find most people, it tends to be, the first question is just, do you care where it is? And for some people, that is a very important question. They're like, well, I live in Austin, I have a family, I might have other reasons why, like I'm not leaving Austin, I'm here, so I'm only gonna look at the ones in Austin. And there are other people like, I don't care where it is, I'll go wherever. I'll go there for 3 months and come back, I'll go there and stay there forever, I'll go wherever I gotta go to make this thing successful. So first you gotta figure out which one of those you are, and then within that, if you wanna stay here in Austin, here are the best bets, or here are all the options. If you're going outside of Austin, I would first try to get into Y Combinator, would be my recommendation, and then I'd be looking at vertical type programs. If you're gonna go somewhere else, go to a thing that just focuses on the types of businesses that you do, like retail or transportation or hospitality, or there's lots of these types of things out there, and that at least if you're gonna go somewhere, I'd go to something like that. The ones here in Austin, we're the largest Capital Factory. Techstars is also a national accelerator that's a great program and has a program here in Austin. And we both focus on primarily tech and software companies. Athena Health, which is a healthcare provider here, a healthcare software provider here in town, has a really interesting program. Their customers, they sell software to doctors, so they have thousands of doctors. So their program is specifically focused on software companies who sell stuff to doctors, so that they can, if they like you, they can then go get you distribution out to all of their doctors. SKU is really interesting because they focus on consumer packaged goods, which I mentioned before, and they've been very, very successful. They've probably had 4 or 5 classes go through that have, I think, all done very, very well. And then finally, Unlimited USA, which focuses on social good companies. And then I mentioned previously the Central Texas Angel Network. Again, we're really lucky to have them here in Austin. It's one of the most active angel groups in the country. They don't just do tech, they do all kinds of businesses. They have an application cycle. It's about every 2 months, and it is a process you go through where you apply and go through multiple levels of screening to try to get to the final part where you get to pitch all of the angel investors. They do monthly office hours, which is a great way to engage with them. Rick Timmons is the chairman and a very person who's around a lot, and here at Capital Factory a lot, a great person to meet, and so is Claire England. So that's another great resource. So as you think about this, this is how I would kind of prioritize my fundraising. And I would generally kind of start in the upper right-hand corner and work down to the bottom, although you want to start there, but most people start here. It's just the practicality of it. And so this says, how value add is the money and how much money do they have. So ideally you want to get someone that gives you a lot of money and has a lot of value add. And so that generally tends to be the good kind of VCs or the best VCs. And so if you could just go to a VC and skip all the angels and just say, hey, just give me $5 million so I can go do this. Well, that's the easiest way to go. So if you can do that, go for it. And some people do. And so that's your first choice. And most people can't do that. Most people, they end up on the other side. They just got to go talk to anybody they can. And the first person that gives them money is usually somebody that knows them, that's willing to bet on them. And then you kind of work your way up the stack and either go to an angel network, find individual angel investors, join an accelerator, maybe get a super angel that has can write bigger checks. But you kind of work your way up the stack. But you prefer to start at the top. Skip the other parts if you can.
Do you meet the fools?
No comment. Structure. Almost everybody that raises money does it on a convertible note. Part of the thing is if you're raising money, you want to not complicate it. You want to be creative about your business. You want to be creative about your business model. You want to be creative about your marketing. You want to be creative about your product. You do not want to be creative about how you raise money. This is not the place where you're going to figure out some better way to fund your company than everybody else. And when you do that, it freaks out investors. Investors don't want to see your creative way of funding your company. They want to see something that looks just like everything else. Investing in your business is risky enough. They don't want to take, so they want to see, you want to show them the terms and then be like, oh great, that's just like all the other terms, and forget about it and not even think about it. And you want them thinking about your business. So 95% of the time that's going to be a convertible note because it's easy, because they're expecting it, because it's ready to go. And maybe, like I said, 4% are equity investments. That means they're actually doing a full stock purchase agreement and investor rights agreement, and they're actually getting shares of stock in your company with that first investment that they make. And then 1% are what's called a SAFE. A SAFE, so a convertible note was not originally designed for the way it's being used. It works pretty well, but it wasn't really made for this. They just kind of took something that was made for something else and they used it in this case. And so then after a while, people realized that and they're like, okay, well maybe we should just make something that's made for this. And so they came up with the SAFE, which is an acronym for something. But it's effectively it's very similar to a convertible note. It just has a few tweaks to it that make it work better, and actually it's designed to do exactly this, to be your first round of funding. And while that makes a lot of sense, and generally it's something like here at Capital Factory we're okay with, it's very slow to take adoption for the purpose I told you before, that you go show it to some investor who's never seen one before, and they're like, what the hell is that? They're like, well here, go to this website and read about it. And they're like, okay, you lost them already. There's I'm not gonna, and so if you have sophisticated investors, then they might be already aware of it and they probably have no problem with it. And then, or if you already have a lot of people on it and you have a big list, and you can say oh well, Chris Shonk invested in it, and Josh invested in it, and Brett Hurt invested in it. They all signed the SAFE, so you should sign the SAFE. Then someone else will probably go do it because they'll take the credibility of the other people that did it. And it's funny, we say, you used to say like you would do a convertible note to avoid picking the price, to avoid setting the valuation, but actually they're all priced now because every deal has a cap on the valuation, which is, you're effectively negotiating the price and the cap anyway, so that's not really true anymore, but so you might hear someone say that a note isn't priced, it's pretty much all priced. A couple more quick things, and I'm going to have Chris come up. Valuation, so the average valuation, if you have a company, you've got a product, you've got a team, you've got some customers, they're paying you something, but not enough to pay pay all the bills, you're worth about $3 million. That's the valuation of your company. It's not based on anything. It's just like, you got to be worth something. And if usually you're trying to raise $500,000 or $1 million, and if you weren't worth at least $3 million, then you'd be giving up more than half the company to your first investors, and that just wouldn't work. So it's a fairly arbitrary number, and it's just what kind of works. So if you don't have a good reason, customers or revenue would generally be the good reason to say that you're worth more than $3 million, you're worth $3 million. And the fact of it is, if you were in Silicon Valley, you'd be worth $6 million. Not saying that's better. There are a lot of trade-offs to that. That does not mean that's better, but that is the fact of it. Valuations are generally double out there, and a lot of other things are twice as expensive too. So on a note, as I said before, think of the cap as the valuation. You're going to get a higher valuation because you have a track record or because you have traction. If you have a good track record, you've done this before, you might get up to $8 million. I've actually seen it higher, but it's just an average, general thing I'd say. You might see a very experienced entrepreneur raising money with very little at an $8 million valuation, much, much higher. And investors are going to do that because they feel like there's scarcity, that it's hard to get in that deal, and that person has lots of people who would give them money, and if I don't give them the higher valuation, I'm just not going to get in the deal at all. And then ironically, you just get a higher valuation because you need more money. Because again, the whole thing's arbitrary to begin with. So say you're doing a business and it actually requires $10 million to get started. Like there's no way to do it without $10 million. You have to buy equipment, or maybe you have to get a bunch of free customers first in order to monetize them or something like that. So then you're going to probably raise money at something like a $25 or $30 million valuation. Because again, you can't give out 90% of the company to first investors, or like no one's going to want to work on it anymore. So that's just kind of the way it works out. So it is fairly arbitrary, and it feels kind of funny when you're going through it. If you have to justify the valuation, it's too high at this stage of the company. Because again, you can't justify it. You have no reason for why you're worth that much money. There's nothing you can say other than someone else is willing to pay for it. Again, competition is a good way to raise the valuation. But if you have to try to explain it, there's really nothing to explain. So what I find, my rule of thumb is you tell them hey, I'm raising money, here are the terms, here's what I'm doing. If they don't kind of immediately brush over that and focus back on the business, if they're asking you why is the valuation that high, or what about this term, then you need to lower the terms. You're making it too hard. That shouldn't be the hard decision. The investor shouldn't be debating I'd invest at a $6 million, but not at a $5 million. If they're going through that, you lost them already. You want them sold on your business, and the valuation shouldn't be the thing they're stuck on. And bigger's not always better. Maybe let's save some of that for the Q&A if you want to talk about it more. But in general, I actually think usually the goal should be to keep the valuation as low as possible, that's still reasonable, until you sell the company. What's really important is you have a very high valuation when you sell the company. Then everybody makes a lot of money, and it works really, really well. And by keeping the valuation lower, you give yourself optionality. You have choices about what you can do, and you have choices. Your company is actually stronger and more robust because you have the ability to go raise more money and to do other things if you need to. And when you drive the valuation up too high, too fast, you're now setting very high expectations, and everything better go perfectly. Because if it doesn't, you're not going to be able to raise. Generally, you want to keep the valuation going up every time you raise money. And if you get it too high too fast, and then you have any kind of a hiccup, you're not going to be able to raise money at a higher valuation, and you're going to either close the business, go out of business, or have what's called the down round, which is very uncomfortable for everybody. So that's the other part. Time usually takes 6 to 12 months. Really fast is 2 to 3 months. If only you had just a very small number of investors, and you're using a safe or some previous just already agreed on document, it might happen in 1 month. Sometimes it takes 18 months, and everybody thinks it's going to happen faster. It's not going to happen faster. takes a long time. So if you go into fundraising, you got 3 months worth of money, it's not going to work because it's probably going to take you 6 months. So think about that. You gotta think about that. No comes before yes. Sounds kind of obvious, but you're going to talk to lots of people and you're going to hear lots of no's before your yes. So you can't get that deterred by that. You have to be talking to a lot of people. You have to get used to hearing no over and over again. And the best way to impress an investor is simply to say you're going to do something and then do it. This sounds so obvious, but it's actually extremely hard to do in a startup. Like, I can't tell you how many startups I talk to, and they're like, next month we're going to close this many deals. Next month we're going to build this product. Next month we're going to whatever. How many times do you think they do it? Most of the time they don't hit those goals. So I'm used to people telling me stuff they're not going to go do. If you come and you say, hey, next month, here's what I'm going to go do, bang, 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 and you come back a month later and you're like, hey, remember last month we met? I said I was going to do this, this, and this. Here's what we did. Here's what we learned. Here's what worked. Here's what didn't. I'm going to come back to you next month. I'm going to do this, this, this. You go do that again? Well, I'm going to start to believe you. That's what you're trying, right? Because then you're going to say, hey, give me this money, and I'm going to go blank, 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 blank. Right? And so that's how you get people to believe in you. And like I said, it's actually really hard to do. So it's actually not that hard to impress people by just doing what you say you're going to do. And that's one of the key things to impressing investors. Part of where I get this from is a guy named Mark Suster. He's a friend of mine, a great investor from LA who runs Upfront Ventures. And he wrote this blog post where he described this as, I invest in lines, not dots. And what he means is a dot is one point in time. I met you, I know where you are now. But that doesn't mean I know where you're going. So I need to meet you a couple times over a period of time and have some dots, because then I can put a line through those dots. Now I know where you're going, and I want to see that you're going up and to the right. All right, so that's the presentation part. Now I'm going to invite Chris up if I haven't put him to sleep yet. Come on up, Chris. Chris, I've known for a long time. Chris, when did we meet each other? Oh my goodness.
Ooh, South by Southwest, and you had just sold your company.
Wow, was it then?
Yeah.
2005, 6?
2000, because I was out of ACT in 2005.
Yeah. And
wow.
And we did a bunch of work together. I was an investor that helped Chris open up. He opened up a whole bunch of Massage Envy franchises here in Austin. That was my first experience with franchising, so really, really interesting. He's now has a whole Massage Envy empire. And I think he's involved in, I believe, a whole bunch more of those businesses here in Austin. And then he's gone on, we've invested in a bunch of companies together. He's got an investment fund where, as I mentioned before, in particular, one of the ways that I think he sticks out from other investors in Austin is he tends to focus more on consumer type businesses and backing them early, which we definitely need. What am I missing, Chris?
It. I mean, we've known each other a long time, done a lot.
Yeah.
I must say that presentation was magical. Like that is the real freaking deal that nobody talks about. So that's straight up.
You heard it here.
Yeah.
All right, great. So that's Chris. I'm really glad he could join us today. As I said, each time we do this once a month, and we always have different investors come up. So this is the first time he could join us. I'm really glad you could be with us here. We're not going to do those. We're going to go to just ask us anything. So from here, we can just open it up and talk about anything you want to. We can talk about our companies we've worked on, we can talk about fundraising, we can talk about Austin, we can talk about any of the things we talked about in the slide today. So, love to open it up to all of you.
You talked a little bit about AngelList and some of the online platforms. Can you talk a little bit more about the value of those and how to use them properly?
Yeah. Start with you, Chris. What do you think?
Yeah, so I think that's probably smart. I mean, you wouldn't have as many lines in the water as you can, and really kind of get some feedback. I mean, the big thing is the competitive landscape. I mean, that's something when Josh and I were going to start in businesses, you didn't know what you didn't know, and you didn't know how to get to an answer about the stuff you didn't know. Well, now that's a different sort of world. There's lots of visibility. You can see investors who might make sense and other companies might be doing something similar, so your competitive landscape is a lot better. I think for a company raising money, it's probably a good idea. There's a lot of people out there just kind of finding them. You'd be amazed by how many people are actually kind of passive angels, just sort of, kind of come 7, come 11 Vegas thing, and they literally hang on these things and they'll drop in 25 or 50 or whatever. So it works. It's a way to kind of get that friends and family money.
Yeah, I mean, and there's so many more options now, than there used to be. 5 or 6 years ago, I was just all chips in on AngelList, and partly I know the people that founded it. And I like all the people there. I think there's a lot of good people there, and they're really smart. And kind of like being early on Twitter, like I've got a lot of AngelList followers, so it's somewhat self-serving. I want AngelList to be successful because I have a big presence there. But their model's changed a lot over the years, and I find there's less and less. It used to be you could go like post yourself to AngelList and find investors you didn't know, and now it's become more of a deal syndication platform where if you already know investors, you can kind of get through it. So I don't find it to be as helpful for that anymore. But now there are so many other crowdfunding websites in particular that are designed to help you meet investors on the internet. Crowdfunding is its whole own thing and is complicated. I think it's generally frowned upon by most other investors because it's like it's basically like, oh great, you've got like a whole bunch of uneducated investors in there who might cause problems, or like, and again, it's something new. And investors don't like things new in that part of it. So on that hierarchy I showed you, I don't think crowdfunding was on there. I should put it on there. Crowdfunding would probably be pretty low because if you can, you'd rather skip it. But what's so great about crowdfunding is there are so many companies getting funded that never would have gotten funded because they wouldn't have gotten funded by a VC. Particularly hardware companies are one great example. And then they're able to use that to validate it. And then the flip side I would throw, Kickstarter is not crowdfunding, it's kind of like pre-selling or customer funding. But I think that's fantastic. And I think most investors really do like that. And that's a great way to validate that there's demand for your product and show to investors, hey, look, we ran this Kickstarter, this many people want it, or I've pre-sold this many of them. That can be a great tool as well. The people that I see successful with crowdfunding, they don't just go to one crowdfunding site. They like hit them all, like one after another. A great example of that to see here in Austin is a company called Plum, which makes a smart light switch. And they have hit every crowdfunding site. And they not all at once. They did one, and then you go to the next one, and then you go to the next one. And if you think about it, they all have different investors on each one. So you can do that. Like not the same investors are on one site that are on the other site. So you can go and raise a couple $100,000 here, and a couple $100,000 there, and a couple $100,000 there. And then by the time you get through all those, it's been like a year and a half. You go back and do the first site again. And like they've totally done that. Now it's a pain in the ass, and it can possibly make it harder for you to raise more money later from other people. But for a lot of people, that they're making it work, and it's really good. So that's something on crowdfunding.
As far as equity, or how much equity you should be...
We're raising our hands here, but we'll let you get away with that one.
As far as how much equity to be giving away, we're at like on seed funding and A, what's the average on that?
Well, you saw the $3 million sort of average valuation, right? So the question then becomes just math, like how much money you raise.
How much you raising? Okay.
So you raise $1 million on a $3 million pre-money. Your post-money is $4 million because it's 3 plus 1. And so 1 million of 4 is 25%. You gave up 25% of the company to raise $1 million on a $3 million valuation. The general rule of thumb, in your very early angel funding, it's not around. You're just like taking an individual investment. So maybe in seed funding, maybe you only give up 5% of the company or 10% of the company, or that's not a round. That's like you just took. But any kind of like round, like with a VC or a real seed round, you're generally going to give up 20 to 30% of the company every time. It's like that. It's just that fraction is going to keep getting taken out. So every time you're going to get diluted by a third. So the general rule of thumb is you want to double your valuation every time, at least. Right, so if your valuation doubles and you get diluted by a third, you're still worth more, right? And that's kind of the having a smaller piece of a bigger pie kind of philosophy, right? It doesn't have to be that, but that's gonna be really common. A heavy round would be like giving up 40% of the company, or like something like that.
It's actually a big problem. A lot of entrepreneurs negotiate. They cap their own future by doing bad deals, kind of like you talked about earlier. You can either give away too little of the company and have a big valuation and look at a down round, or you can give away too much. And angels do it too, right? Because they're out there, and most angels aren't professional investors, so they're trying to get the best deal they can get because this might be the one that pays for them all, right? And then what happens? It comes up to Josh or I or other VCs, and it's like, whoa, this whole cap table doesn't work. Like, you've already given away 40-50% of the company. You just barely got a little bit of revenue. Like, there's got to be a Series B after this. You got 4 founders. Like, whoops, kind of thing.
And that's where you have to be really careful when you're working with people who aren't experienced investors. So like one of the questions you want to ask is like, well, how many other companies have you invested in? And ideally you want to reference check them. Like, go talk to can I talk to some of the CEOs of companies you've invested in? Like, that makes you look good, not bad. But we see lots of bad deals that come in, and nobody had bad intentions. But if you don't know what's market, and know, and you're just negotiating a deal. You're not doing anything trying to hurt anybody, but you might agree to something that's not going to be good in the long term. And so, one company we're working with right now, you know, they agreed to, or sorry, a friend of mine's working with, they agreed to, they brought in some investors and they gave them effectively 40% of the company for that first small amount of money. I mean, like, you know, tens of thousands of dollars or something, and it was non-dilutable. Whoa. Like, which is like, it's a poison pill. It's just like, okay, your company cannot move forward until, and then you have to go back to the investors and try to explain that to them. Like, okay, like, you know that thing we agreed to? It was kind of like, I didn't know any better, but that wasn't a really good thing to agree to, and you know, like, and we're kind of stuck. Like, we can't move forward until we fix that. And so I need you to agree to take like half of what I told you I was going to give you. You know, like, never goes down very well. We've made it work before. Like, I've been able to help people have that conversation, but it's hard, you know, and so part of that's having, you know, feeling like you're having experience, you want to work with someone that's done it before. And then one good reason to use the note, the convertible note, or a standard set of documents on the internet is you can say like, hey, look, this is fair. This is what everybody uses. Like, we didn't agree to this special. Like, we're using the same thing everybody else does. And we know it's fair because everybody else is doing it. So, a quick guy.
Can Capital Factory work with or help connect the weirdos who come to town to commercialize technologies outside of your core competency?
Give me an example.
So I've got patents on tornado-proof housing, which is super insulated. Probably don't have many building tech companies here, but geographically, Austin makes a great deal of sense for what I'm up to. And so I came here to work with the city of Austin. And so I'm looking to make connections.
Yeah. So but you just have a patent. You don't have a business or a product or a...
Yeah, I've got a business. I've got several scientists on board. I've got...
Are you selling anything?
I'm starting on LOIs in the next couple of weeks. Yeah.
Okay.
I came to Austin.
So I mean, I think... you know, we do a lot of stuff around commercializing technology, and we have a lot of big companies coming here looking to meet startups that they can work with in different ways. We actually do have companies in the construction and building space, you know, at the stage that you're at, it sounds like, you know, a big part of as far as the way Capital Factory can help is that we have this community. It's that you're plugged into all these people, and so as you saw maybe in the video, if you saw the video at the beginning, you know, people talked about, hey, I met my co-founder here, Well, like, that wasn't like through like some co-founder sign-up program. That was like, that's just what happens here, right? It's like people are meeting and they're finding each other, and there's, whether it's through the kitchen and what's happening in, you know, where you meet somebody getting a drink, or it's the events that are happening here, or it's looking through the directory and finding people, or going to office hours and networking and talking to people, you know, you want to, at that level, it sounds like you want to meet as many people as you can, and so you want to put yourself in the, you know, in the fire hose, right? And that's what this is. Is putting yourself in the fire hose. At the time where you start to like have a little bit of traction and like people starting to be willing to buy it and things like that, that's where, you know, there's access to other mentors, to funding, to some of the customer pipelines that we talked about, and things like that. Sorry, the gentleman in the tie, and then we'll do you and the feeds.
So inherently, there's kind of a disparity in bargaining power, right? You've got folks with lots of money, and you're trying to convince them to invest in your idea. What is the protocol for?
Inherently, there's not that balance. I'd say inherently it could go either way, but I think I understand your question.
But kind of in what you've been talking about, there's a disparity, right? So you've got a startup who's going to folks with lots of money. How do you make sure those individuals aren't going to pirate your idea? In other words, are you going to offend them to ask them to sign an NDA or something of that nature?
Yeah.
Great question.
Yeah, you will offend them, so don't do that. I mean, yeah, maybe you'll offend them, but no one's going to sign an NDA. So, or nobody that you want to invest is going to sign an NDA. So, so that's it's just not a practical solution. Because as an investor, it would be very irresponsible for me to sign an NDA. You know, I meet with 1,000 companies a year. If I had 1,000 NDAs, how could I possibly even honor them all? You know, like I'd be automatically conflicted all the time, right? And so I just can't do that. I'd be submitting myself to so much risk because I'm gonna talk to another company that has the same business idea as you. Because I talk to so many companies, and I've almost never seen a business idea that was actually completely unique, right? So I just can't do it, and all investors know that, and investors aren't going to do that. As far as how you protect it, honestly, look, there's two parts to your business, right? There's like, here's what we're doing in general, and then there's like, we're Coca-Cola, and here's the magic formula to Coke, right? Or we're this big data company, and here's our secret algorithm. right? So first of all, I just want to point out that there's a big range between telling people what you do and giving them the secret formula, right? And so, you can talk to a lot of people about what you do without necessarily giving them the secret formula. And it seems like the thing, certainly if you have a secret formula, you should protect the secret formula. But that doesn't mean you can't talk to lots of people what you do, and there's lots of ways to talk about what you do and the effect of what you do without giving away the formula, right? And most businesses I see don't actually have a secret formula. So separate from that, the actual risk is extremely low. So I've been doing this for 10 years. I've seen thousands of companies. And I think I know of one time where that happened. Where I feel like where I know someone got screwed over, or it seems like they got screwed over. And I know of countless times where great things happen because somebody talked to as many people as they could talk to about their idea. And so the relative trade-off of like, what's my risk factor? Should I not talk to people because somebody might steal it, or should I talk to lots of people because something good might happen? You should talk to a lot of people because it's very low risk of somebody stealing your idea, and very high likelihood that something good's going to happen from talking to lots of people. If you think about who's going to steal your idea, I mean, like for example, you come talk to me. I'm on 9 boards. I'm an investor in like 200 companies. I'm running a company, and I probably have 5 or 6 of my own ideas of stuff I want to go do. You better have a damn good idea if I'm going to go drop all this other shit I'm doing to go do your idea. Right? And I better be damn good if I'm going to do it better than you're going to do it, because you've already been thinking about it longer than me and you're totally focused on it right now. So in some level, if I'm going to do that, I probably deserve to go take it from you. So I think you gotta think about that. Like, I mean, look, don't go talk to a direct competitor about it who might be in a position to go do that. But in general, talking to investors, you should make sure to tell them something's confidential. Like, hey, I don't want you to tell anybody this. Like you have to communicate that kind of stuff. But in general, I wouldn't worry about it. In general, as an investor, if I ever developed a reputation that people were saying, like, I went and talked to Josh about my idea and he fucked me over, like, I'm done, right? So I better work really hard to not have that be the case. So I've got a lot of incentives not to do that. And like I said, in general, you're going to do better. Now, it's an extremely common question. It's not like something, like this is something people ask all the time. Every one of these sessions that comes up. So that's why I have such a prepared answer to it. It's not that it was a bad question. It's a very, very common question, but that's my strong feeling on it, is you are going to get way more from talking to as many people as you can. There's some risk out there that you could, just like there's some risk when you get in your car that you're going to get in a car accident. But you're more likely just to get where you're going faster.
And to follow up on that, it actually works against you, because anybody that asks a professional investor to sign an NDA before I tell you my secret sauce, it's amateur hour, right? You've immediately just moved yourself into amateur hour bucket.
And maybe just to say when I said at the beginning, like, do your homework first. And that's part of why you're here, right? Is to hear this stuff. So you're doing your homework by coming here. But that's part of the thing. If you go ask for the NDA, they're going to go, you didn't do your homework. Like, because if you go search the internet for, like, should I ask investors for NDAs, you're going to find a bunch of other stuff saying, don't do that. Let's go other side of the room for gentleman in front. And then.
Hey, one of the things I'm looking to do has a component that's machine learning. I've been to 3 or 4 meetings here. They've been really great, so thank you very much. How strong is the machine learning piece of the Austin tech ecosystem?
I think it's really strong. Lots of big, data people and doing stuff in machine learning. There's a new AI meetup that just was here 2 weeks ago, I think, that just started. Okay. Lots of, look at lots of the big companies here churning out talent that has that kind of experience and giving them experience in it. So I think really strong.
Yeah, I think we have an unfair advantage here. I think there's a couple industries here where Austin's DNA is super strong, and I would say software, machine learning, AI, that stuff. Because there's the video game background with the enterprise software background that's really leading to some cool dynamics in that world, right? So.
Thank you.
So you were talking about if you have capital-intensive business that's very scalable, you need to show that you have a track record in order to go to a VC and be like, hey, I need a bunch of money from you, invest in me. Well, if you're a student and you can't exactly go sell your product because it needs FDA approval beforehand, so you can't really prove that there's a market, other than really, saying you're going to do what you do and then doing it. What other suggestion would you have in terms of building
much FDA approval?
LP, so I make it a job to stay in my lane and as soon as I become B+ at something, this is just like any ops guy, right? Is know what you do well and know what you don't do well, because that's the danger zone. And so I'm an LP in a couple of funds that do things I would never attempt at doing because it requires way too much PhD, or it's in a market I can't access or something. So I would talk immediately to rock stars, because you're gonna get nothing but misinformation from angels most likely, because what you're talking about is very specific with a very unique set of hurdles attached to it. And there's investors out there that specifically focus on those industries. I would talk to them, because all you're really gonna get is misdirection for the most part from generalist investors.
Yeah, an example of that on the VC slide I put up with Sante Ventures, who
great.
focused on that kind of stuff. And so when you go talk to him, he's gonna be like, oh yeah, I totally get that that's gonna take that much time. And I know, and I've worked with businesses like that before. I'd say here at Capital Factory, we've got the general rule of thumb that I told you about, and then we accommodate for the business. So if you're building a hardware business, you might not have, we would work with you before you potentially have the product in market, because it's a much longer cycle to do that. Or if you're doing something in biotech, or something that might require FDA approval. Now you said in there, I need FDA approval, so I can't prove that people want it.
No, I can't go out and sell it is what I mean.
Well, you said that, but then you also said something along the lines of, so I can't prove that people want it. And I would challenge that and say, there's lots of ways you can prove people want it without selling it, so you need to go do those things.
That's one thing that I did.
Taking those other steps to do it. So I skipped you, and I'm really sorry, so let's bring it back to you.
So you talked a lot about products company, right? Software, hardware, that type of thing. So what about service companies? Like service companies oriented, focused on technology, focused on software. Does it make sense to get funding from these types of companies? And if so, how would you go about doing that? Because you don't really have a product. Your product is you. It's the service that you provide.
Yeah.
How would you go about doing that?
So, I mean, I like service, I have a service company. There's natural advantages to hardware, there's natural advantages to software, there's natural advantages to service companies, and there's natural disadvantages, right? So there's trade-offs. I think that service as a platform is sticky, right? It's a constant tenants match, it's engagement. It's not just sort of like, here's your product, see you for the next update kind of thing, right? But it's humans helping humans. And so that's what's great about it is also what's terrible about it, right? So there's some natural hindrances to scalability, there's some natural issues, because most of the issues, if you nail your market and your product, is gonna come in the people side of it, and you're going long people in a service business, so just know that. But I would really look at it, how do you take it from a service business and borrow some things from other business models you like better. So look at the software, MRR, stickiness kind of side of things, and use that sort of revenue model approach. So I'd be tech-enabled service, not service-enabled tech, if you're in your specific position.
Yeah, I would just add, look, most of the time, it depends what kind of service business you're talking about. If you're saying, we're building an accounting firm, or we're gonna do, Salesforce consulting, or we're gonna do, that type of a service business where it's literally like, I get paid by the hour to come do something for you, and my business scales linearly with how many people I have. The more people I have, the more hours I can bill, the more we can grow. That type of a business typically does not attract investors. Typically you bootstrap that kind of business, both because you can, because it's a cash flow business, and because it's hard to get investors to do that. That business is not going to get the same kind of multiple. If that business is doing $1 million in revenue, it's worth $1 million. If a tech startup's doing $1 million in revenue, it's probably worth $5 million. And it's just, and they get a multiple because the technology can scale and things like that. And sometimes if you're doing $1 million in revenue, you're only worth $700,000 as a service business. So you're typically gonna get different kinds of investors. People who have experience investing in that type of a business, or maybe know your industry, or maybe know you. The other challenge I find is, at some point, like if you do take investors where it is a service business, I don't know, for some reason it feels bad. It feels worse to be paying the investors like 5 years later, like when you're like, well, why are they still getting 10% of all my revenues? Like, I don't know why, I just find that feels worse for service businesses too, because they feel like they're doing all the work. So it just doesn't tend to happen as much.
That's fair.
So we actually use services to bootstrap and kind of learn what the software was that we ultimately wanted to build, and we're kind of at this place where the revenue of the software is starting to come close to that of the service business, and we've kind of separated them out. So as we enter into this area of fundraising, there's kind of two paths that I would love your advice on, things that things to consider as to which path would be better for us. And option one would be to sell off the service business to a prospective buyer, and at the same time, that's we've become accustomed to that particular revenue to fund us, right? So that's kind of like a tricky timing thing, but hey, it would be nice to like have that cash to not actually have to go raise money. The other would be to continue to kind of keep the entities separate and actually just raise money on the software side when it would be appropriate, but the key challenge there is for us to be seen as a software company and not necessarily a service business. So I'm curious, have you guys seen a lot of deals like that? Like, when is what's the timing in deals like that look like? What are some things to look out for?
Yeah.
Go ahead, sir. Go ahead, Josh.
I've seen a bunch of them. I've done it myself. My first business started as a services business, and we eventually built our own product and moved everybody over to it. And I know lots of people going through that, and I've done that. It's your very common problem. You get stuck on we're addicted to the cash flow, how do we get out? I think if you can partition off and sell that business. I'm not sure I saw your point, because it seems like if you sell it, then you get a big chunk of cash, so then you shouldn't be worried about the cash flow of the other ones. So that seems like a great solution is you sell that business, you get a big chunk of cash, that's what you fund the business with, and the other thing goes away. If you want to split it off and raise money separately for the software business, what you're going to generally have to do, unless you're taking money from people who know you, kind of inside deal type thing, is you're going to have to very cleanly separate them and be able to make the argument. The concern is going to be your time and the people who are running it, and convincing the investors that they're going to want your time 100% focused on the thing that they're investing in, and not have your time split between them. And so if you can do that in such a way where you're like, no, like I hired a manager, that person's totally running it, it's totally self-service, I spend 2 hours a week on it, but it's like, it's totally running by itself, and my focus is totally on this. You're gonna have to have that conversation, but they might be okay with that. You're gonna have to convince them of that. And we're gonna get into trouble is like trying to have your cake and eat it too, and kind of do both, and investors generally don't like that.
True. I completely agree with that whole assessment. And I would also add that it's probably more intertwined than you think. That's a very academic solution to just sever and piece out and there's a new pot of money. But anytime you develop a product off of having a dialogue with your customer and then honing that product, there's a lot more sort of DNA overlap than you think, and it's that umbilical cord doesn't disappear as fast as you would assume.
I just quit my job last week. I have been making.
It's the only place you get a round of applause for that.
But I have been making money. I have my software service business. I've been working on this for years. I have a team in India, so I used to do this parallelly, right? I make good money. I almost make what I make off my paycheck, right? So I'm thinking how do I make it big, right? But this is a software service, right? I do applications, tech applications, software applications and stuff, custom applications, right? Does Capital Factory, guide me, they have something they can guide me, how to make it a really sustainable business, is it advisable for me to approach investors I have records showing mine is a good profit business.
Yeah.
Right?
So yeah, this is totally the kind of place that could help you with that. It's not that we have here's the class for people like you and we're gonna do it for you or tell you exactly what to do, but we're gonna surround you with all the right people who are also dealing with those same challenges so that you can both find people to work with, get ideas off that, and then through the mentor calendar, maybe meet with some different people who maybe have experience in that exact same thing, who have been in a consulting business like that, who are trying, have already been through that before, who can advise you as you kind of go through that and try to figure it out. Because each business, is often so different too. And so you want advice that's kind of, tailored towards you and what you're trying to do. But that's a big part of what Capital Factory is really about, is about connecting people together and helping you match up with someone who you really like and they really like you and they have some experience or they've been through this before and they can help you through that journey.
My second part of the question, like, is it meaningful for a business like mine, like to approach an investor, like saying, hey, you know, I do more sales now, you know, this business has been working, I do more sales, I'll attract more business, you know, like I'll make this a much profitable company.
I don't understand the question.
So, you know, the way I see it, like, you know, for making the business bigger is like doing more in sales and marketing, right? Like, you know, is it better for a business like mine to approach an investor? Like, hey, you know.
Better than what?
To make the company bigger. Like, the goal is to make the company bigger, right?
Well, better is comparing it to something else. I understand, like, what as opposed to, is it better to make the company bigger than not make it bigger? Like what?
So I make some kind of profit. I need to, my goal is, of course, to make more profit, right? Like 10 times the profit I made, right? Is it better to approach an investor at this point, like, hey, you know, I have a working model.
Yeah.
Like, you invest in my company.
Yeah, we're not gonna be able to answer that here. I mean, I think that's what we're saying. That's what you have to go actually have somebody get to know your business. You know, it's I don't know what your business does. I don't, you know.
Oh,
so
yeah.
I couldn't
But
tell
in
you
general,
that.
like, at a high level.
It's not really general. It really matters, like what your business does and whether or not that would make sense. Like, it sounds from what you said so far, it sounds like a consulting business, like we were talking before, that I don't think you could raise money on. But I think that's, you know, that it really matters what you do.
Okay.
So that's the kind of thing you want to sit down and talk to somebody and get some advice about. Let's go way in the back.
Chris, what's your investment criteria, and like when should you approach a VC and when should not?
So Josh is right that we're definitely more revenue focused here. So it's kind of like, great, you know, investors don't want to invest in building something. They want to invest in scaling revenue, right? Typically speaking, that's kind of where a lot of the risk is in that zone. However, on the consumer side, there are some people that kind of understand, you know, if there's a bunch of people at the party, then you can now start passing out chips and booze, right? But so there's certain folks that kind of have that DNA, they know how to, the funnel, customer acquisition, they get it, right? I would say for venture is, you know, our fund, we specifically invest post-product, right? So you have a product and some initial KPIs and some revenue. Like, we don't need, you know, $100,000 of, you know, of monthly revenue, like the West Coast kind of A's, whatever. Like, all we really need to understand is the market, the team, the funnel, the value proposition, call up some customers who aren't like Uncle Fester or college roommate, like truly like found source customers, and be like, all right, I mean, it's the simple shit, right? Like, what did you do before? How compelling is this for you? How are you paying? You know, like all that kind of stuff, and be like, all right, how is this market? But a lot of it comes down to cap tables, money you raise, team. But that's what we like. We like a little bit of revenue on a market we understand, and we stick to our lanes on markets we understand, and we kind of just try and run the same play and help the next generation out. Does that answer your question?
I actually have kind of a tag-along question. I'm in the middle of those two phases of build-out versus revenue. We've been launched, and we've been in the market fully bootstrapped. Everything's good to go, but we haven't started bringing in any money. How bad does it look to investors that we've been launched for about a year now and we don't have a lot of revenue coming in? And the reason behind that is because the marketing isn't in place, which is what we need the money for.
So let me make sure I got this right. So you've got a product, you've got a way to make money, but you haven't made money because you haven't failed to market.
Right.
Well, that doesn't make any sense to me.
Yeah, are you not charging for it, or are you just not promoting it?
It is a very tight-knit community that we would be marketing to, so it's a difficult niche market to.
So what have you been doing for the past year? You built a product, it's been a market for a year, and no one's using it?
Pretty much.
Yeah, we don't have time to go into all the details, but without knowing more, then yeah, it's like, well, why isn't anybody using it? You know, like, why haven't you got, I mean, you can say it takes a lot of money, but like, why, you should get somebody to use it, like, right. You know, like, go find one person, two person, you know, like, you get feedback on those things. I don't know, I mean, sometimes it's like, hey, we've been building it this whole time, or like, here's how we can show that it's all, you know, if it was like, we've had 10 people using it for the past year, well, we've been learning all about it and studying everything they did, and now we've made the product perfect and we're ready to go roll it out to 1 million people, you know, like, that starts to sound more
That's basically the case.
interesting, you know, like, that kind of makes sense, you know, at some level. But you have to have a story, you have to, you know, explain why you're in that spot, and you know, it's more important, I mean, what's most important is just like, well, here's where we are now, here's what's about to go happen, you know, like, and if you can effectively convince or prove that, hey, with this money, we're gonna be able to acquire customers, we're gonna be able to do this, ideally, because we have some data that shows that, you know, that typically would get over it.
Just know that you're in a very fragile state right now, right?
Yeah.
And Josh and I posted, but there's sunk costs, there's emotion, there's this or whatever, right? And yet there's no revenue. So when you wake up tomorrow, guess what does continue? The burn. And guess what? You don't have revenue. So there's a lot of danger in this zone for operators, for angels, for VCs, and most people just knock and be like, come back when that revenue proves itself out because the risk reward doesn't work. But really the big thing is the opportunity cost, right? Because maybe you have something really neat now, but without a revenue model, without funding, everything stales, right? And so you might have a very small window of like acqui-hire, here's my tech, big company, you don't have this thing, because you don't have a revenue model behind it. But every month that burn continues, and if you raise more money, heaven forbid, without having a revenue model for a long time, you limit yourself on actually ability to monetize out of your company and deliver it over to some big sloppy organization because you've sunk too much money in it.
So we have time for probably about 3 more questions.
So we launched about a year ago as a digital media entertainment company, like Vice Media, for a different audience. Since then, we've figured out that the most valuable thing that we have is our WordPress plugin that we developed. We have tremendously high time on page for our, compared to a lot of our big competitors. So now we've decided we're going to pivot and basically become a SaaS company focused on this WordPress plugin.
Very awesome thing to do.
Okay, good. So my question is, like, how do we talk about this pivot, right? And what's the best way to kind of tell that story?
We're launching a new company.
It's a new company.
Ditch the baggage.
Okay.
Guess what? We got a new company. Here's what it does. Built on this technology we've been developing for the past 2 years.
Okay. And so the investors that we have, convertible notes, do they just become?
That's a much more complicated question.
Yeah.
It kind of depends on how much money you raised, your investors, what their expectations were, what your relationship with them is.
Mm-hmm.
So what you want to do for them and what you can do for them. And so sometimes one obvious answer would be it actually is the exact same company, they maintain their investment, and if, for example, I can give you an example of a company I invested in, I don't think this is very confidential or anything, but so I was an investor in Outbox, which if any of you ever used it was the greatest thing that ever happened to postal mail.
Oh yeah.
And unfortunately, even though they built they failed better than most people succeed in this town. I mean, they had built the most incredible product. They had a bunch of people using it. They had awesome press, and they decided that they did not think it was a viable business, and so they stopped working on it. They'd raised about $4 million. They'd only spent about $1.5 million. So they were like, "Hey, we're going to go start a new business." We got $2.5 million. They were really smart and they were, didn't waste their money.
Right.
And so they didn't have to go do anything different. And I'm still an investor in Able Lending, which is their new company, which I'm really excited to be part of. A lot of other times, they shut down the other company and start doing it. And all the investors that invested lose their money. And they say, "Hey, that didn't work. We're going to try something else now. You want to invest in that thing?" Depending on how you failed, if you did it right, a lot of investors will give you the money the second time.
Yeah.
Particularly, I'd say communication is a huge part of that. The way that you communicate how you fail will dramatically affect people's willingness to invest in you again. Another example, another company I was in, we invested, they raised some money, they ran it for a while. They were getting low on money, they didn't quite get the product market traction they needed, but they felt like they had developed something useful in that was different, a different take. And so they recapped the company, what we call the down round, we mentioned before, things like that, but they effectively are crammed down. They basically took all the other investors, and that was, so maybe at the time owned, say, 40% of the company or something. And I don't know the exact numbers, but that became basically 5% or 10% of the new company. So we didn't lose all our money, but only a small part of it became part of the new thing. And they were like, "Look, in order to make the new thing work, we got to go raise a bunch more money, and we can't do that unless with all this baggage from the previous company. So if you want to be worth anything, we need to cram you down so that we can go raise more money to do the thing that we think is going to work." And I invested in that second round because I understood what had happened. I liked the team. I understood what went wrong. I didn't think they were like bad people or stupid or anything. Like it didn't work, and I liked the new thing they were working on. It looked like they found something, and I had helped fund that. Like they wouldn't. I paid for that already, so it's kind of a sunk cost thing. But it's like, well, I mean, like that's my money. Everyone else is about to go make money on. So like, why shouldn't I be part of that too? That company's well, I won't say which company it is, but anyway, yeah. So it happens, but that's a difficult situation, and it's really different for each person. You got to figure out, and for each company, like how do you want to handle it? Obviously, ideally, you'd be like, no, I want to like take care of all my investors, make sure they all make a lot of money, But unfortunately, and at the same time, you got to realize that they went into this knowing they could lose their money, and that that was part of the deal. And I don't want to get mad when somebody loses their money. I get mad if somebody acts inappropriately or irresponsibly or unethically, but I don't get mad when this company goes out of business. It's like, all right, we're big boys. Like I knew that was going to happen. I knew that could happen. I should have been investing otherwise.
If anything, it's a way to kind of really vet somebody out. Like there's two. I mean, I've had multiple kind of losses. I don't think everybody in the space kind of does it at a time. But to Josh's point, I mean, these two guys, they had another idea, and I couldn't wait to back them because at least they know now what they did wrong, right? So even if the trajectory is exactly the same, but they know where these three potholes are, they'll out-index that, historically, right? But a lot of it is that communication, how they managed it. Like, are they people that you want to go the next round in? And I think it's a good thing. Like when I see somebody that got that golden boy, golden girl, never lost kind of thing, that basically means they're not trying hard enough or they're surrounded by idiots. Like something's wrong there, like you can't be in this game long enough and not have some setbacks.
As a different example, Evan Baer, who's the founder of Able and Outbox, recently, I believe it's all public, he stepped down from the company as co-founder. Will is now the CEO, and I think he's looking to do something new. So I got an email from him as an investor saying, hey, you're going to see this in the news. I'm stepping down from the company and want to let you know, and I'm going to be doing something new, and blah, blah, blah. Now, this is the one who they were great. I love them anyway. I think they're great entrepreneurs and whatever. But they tried this thing. It didn't work. They pivoted into something else. They made good use of my money. They were good stewards of the money I gave them, and they turned it into something else. I'm like, Evan, where do I send the money? Then you can tell me what you're doing. Like, I don't care. Whatever you're going to do, I want to invest. One, I think he's amazing, and I'm sure whatever he's going to go do, it's going to be super interesting and amazing and ambitious, and I back anything he'd go do. Because I trust him, and I know he's going to take good care of my money, so I don't care. I'm just like, Evan. And to the scarcity problem, the other stuff, I don't care what the terms are. Because I know he's not going to do stupid terms. I'm just like, I'm literally bugging him, like, Evan, what's your wire info? Like, I'm just going to send you $25,000. You can tell me what it's for later. And when you're and that happens to people a lot when they're really good entrepreneurs. You get, that's where you want to be, right? Your investors, once you make them a bunch of money, they're just like, dude, whatever you want to go do it. We've got time for one more question. Sorry, we'll do both because he didn't get to ask one. Go ahead.
As far as office hours, about how long is that period of time that you meet with?
It's a little bit. It's usually here. It's a half an hour. Sometimes it's 10 or 15 minutes. So short period of time.
Thank
you. Is it always like the startup teams together naturally, like friends, or are there any cases like a guy has a business idea but can't find a coder, for example, and do you provide any events or services for them?
Matchmaking. Yeah, all the time. And if you said in the video that I played earlier, I don't know if you saw that, but a number of people said, hey, I met my co-founder, I met my co-founder here. So one, we have specific events. There's an event, I think, on the third Monday of the month every month, which is the co-founder meetup that happens here. And so 10 different companies get up and pitch that they're looking for co-founders or people who can help them, and there's 100 people in the audience. And even if you're not pitching, it's just a good networking place because everyone there is the kind of people that are looking to join startups. If there's something happening this weekend here at Capital Factories, it's too late to join in this. It's called 3-Day Startup. It's a weekend hackathon. Hackathons are a great place to meet co-founders. Big selection bias, right? Kind of person that goes to a hackathon. Yeah. So the kind of person that's ready to go join a startup. And best way to test them out because you get to see what it's like to work on something intense with them where you have to stay up all night. You see if they smell bad and what they're like when they're grumpy or whatever. Way better than getting coffee with them to seeing if you like them and you want to work with them and what they can really do. Just the networking. The personal networking part. Again, that's what happens here. Like a lot of reasons why people become a member here and go sit in the kitchen, why you want to work here on the top floor where everything's open and you can hear what everyone else is saying and everyone's kind of like bouncing off each other, is because that's how you meet co-founders.
Is it before the investment stage or after it?
Most people are here before the investment stage. Yeah, I mean, we have another floor with offices that people rent and things like that. That tends to be more after. But I'd say so we have both. Like there's definitely both. But I'd say probably more of the people are here before that. And generally, about a third of the companies that we invest in come through working here first. So it's not even the majority of them. We invest in lots of different companies, but it is a major way that we meet companies. And I say to others, our due diligence compared to other types of investors is that like we live with the companies. Like I know people really well in a different way, because like I know who's working really hard, because I'm gonna leave here in a little few minutes to go to my next thing, and I'll see who's still working here right when I leave. And like, I go to use a conference room, and oh shit, they have that conference room again. Like and they're meeting with that person. Like like they're doing business, or seeing which companies take talent from the other teams. That's a really good signal, because the talent knows where to go. So it's a great resource for us to get to really know people and know who's really doing good things. Great. Well, hey, really appreciate all of you coming to this. Again, would also appreciate it if you could help spread the word. I love seeing this room full like this, but that's only because people tell people about it. So if you could post it to Facebook or share it on Twitter or anything like that, again, it's just atxstartupscene.com. We do another talk that is Intro to the Austin Startup Scene on the third Tuesday. That's for people that are new to Austin, looking for a job, anything like that. I got a couple more announcements, I'll let you go. And then we also do one that is for people that are interested in becoming a mentor or an angel investor. That's a different type of session that's more about talking about how that works and how you get plugged into that and do that. I want to point out a couple people in the room real quickly. JD Weinstein in the back. JD is our venture associate, so he helps run the accelerator program and has worked with lots of companies raising money, knows all the companies here and what they're doing, and so he'd be a great person to also talk to or get advice from, and he'll stick around for questions after. Arij on the other side works with JD, so she's another great person to talk to in a similar way. She helps run the accelerator program too. Paula helps put on all the events that are here, so she knows all about working here and about events here and things like that. Would be a great person to talk to. I don't think I missed anybody else. And then Liz gave you guys the tour. If you actually want to work here, anything like this, Liz is the person to talk to. She actually gets to say like who sits where, which desks, or which offices go who, things like that. Other than that, I really appreciate you coming, and hope to see you again soon. Thanks. I got somebody meeting me right now, and I got a 7 o'clock meeting.
Right on, man.
Yeah.
Where do you spend it?
I do that. Okay. My Tuesday routine is it's always like a talk before maybe 6.
I like it, man. It's good rhythm. This is fun.
Yeah,
you too.
Funny how I figure like, what do you mean? I was like thinking to myself, all the resources like just proven. So like, it's not like that was, dude, remember all that stuff? That's been a long time. Look at all this. Cool. Good to see you.
Hey, I know you're real busy.
Some programs like Techstars will take companies in that just have an idea written down. And our program particularly.
I mean, they are an accelerator, but different companies are looking for different resources. So just making sure. For us, it's usually you build the product and go. Yeah, no problem. Howdy, how's it going? That's actually awesome. So yeah, a lot of I don't think so. I'll double check it. Not as much as I was but once you